Hi, everybody. Happy New Year, and thanks so much for joining me. Before we get started, please take a second to click subscribe to my channel to keep up with all of my latest investing and personal finance content. And please check out the link you see on your screen for a message from our sponsor, The Motley Fool, where you can get the top 10 stocks to buy right now. This should not come as a surprise to anybody, but there were a lot of stocks beaten down last year. A lot of my favorite beaten down stocks, though, aren't at their all-time lows. If you go back, to the pre-COVID era, even some of the most beaten down stocks were trading for a lot less than they were right now. One of my favorite stocks in my portfolio is Block, also known as Square. It's come down by like 80%, but it's still 5 times what I paid for it back in, right after its IPO. So there were a lot of stocks that went public either by IPO or SPAC in the past few years that are trading at their all-time lows. So Tyler, first of all, thanks for joining me. And second of all, what is a stock that's kind of at its all-time low right now, or very close to it, that you're thinking of adding to your watch list?
Well, it's definitely on my watch list. I find it a kind of an intriguing company. It's called Enovix. They are a new generation battery company. When everybody hears that, they immediately think electric vehicles. This is not the case. These guys mostly make smaller size batteries, things that typically are going to fit in handheld devices, things like that, where weight, portability is going to be one of the big issues, and but at the same time deliver superior function or battery life, ability to hold charges, things like that. They're interesting in the sense that they're not trying to invent a new battery chemistry. They're actually guys that came from the chip manufacturing industry and are just like, hey, why don't we take the efficiencies that we learned in chip manufacturing on being able to write on a smaller, the distance between wiring and things like that on a chip have gotten smaller and smaller. It's like, what if we did that in the battery? So typically batteries, it's a electrode and cathode with a separator on sheets, and then they're kind of like folded into a battery. These guys have taken, we're going to just cut into small sections and do this. It increases surface area, things like that. Basically ways to improve the performance of what's actually in the physical constraints of the battery. Their challenges has been manufacturing to automate this and actually get it up to scale. The concepts they have built are there, just the ability to manufacture it at scale, profitability have not been there. The stock has absolutely tanked because management has not been able to meet those targets so far. And actually just last week, the executive chairman did a long presentation on why they haven't been able to do it, because they sacked their CEO. They brought in a new CEO who had long history with AMD, and they're basically, trying to implement silicon chip manufacturing principles and all that stuff into this business. At its current price, I think it's a little bit more interesting. It has fallen precipitously. Actually, I think last week in a single day, it dropped more than 40%. So based on what it's doing at this current price, I'm going to be intrigued to see what happens from here.
Yeah, kind of similar case to a stock that I own called Proterra, which was my, battery play that I bought in the SPAC boom. They develop battery systems specifically for large vehicles like buses and things like that. Definitely one that I'm watching. Very intriguing technology, but there are no shortage of SPACs trading for their record lows, especially in battery technology.
Yeah, I think they're all at their lows.
Yeah, they're pretty much all at their lows right now. So the one I'm watching is a stock that I don't own, and it wasn't a SPAC. It was an IPO during the COVID boom, I want to call it, in the market. It's Airbnb, a stock that I know you know pretty well. The things I really like about Airbnb is there are a lot of companies that are still growing quickly in the current market, with 30 to 40% growth rates, things like that. But if you're throwing enough money at growth, any company can grow at that kind of rate. There are very, very few companies that are still posting impressive growth numbers while doing it profitably. And Airbnb is one of those very few companies that's doing that. Profitable growth is a really hard thing to come by in this market. Airbnb, their gross booking volume was up, I think, 31% in the most recent quarter. despite the pretty challenging environment, we're seeing the post-COVID appetite for let's get out and do something start to fade away. Now it's more business as usual when it comes to travel and vacation planning and things like that. So that was really impressive to me. They have about a 20% net margin over the past 4 quarters, which is pretty impressive. Management apparently agrees that the stock's cheap. They authorized a buyback, which is kind of rare for a rapid growth company, about a $2 billion buyback. And I liked Airbnb when it was trading for twice the price. I think despite what you read on social media about everyone's bad experiences with Airbnb, and there's no shortage of those, when you are renting to millions of people, you're going to have people who are unsatisfied. You're going to have horror stories. If you interviewed every Marriott customer, you're going to hear stories of someone who their tub had 10 roaches in it. Bad experiences happen. But what is kind of what is a clear trend is that people's travel modes are changing. People want more flexibility. People want more space when they travel. People want unique experiences that hotels don't provide. And I think that trend isn't going away.
Just to give you a little extra context on this, I have been in an Airbnb for 3 months while my wife and I have been back in the United States on maternity leave. So clearly, like, use cases like that are certainly there. But to give number to what you were saying, because I was doing some work on it recently, for the 9 months so far in 2021, its operating costs, like not cost of goods sold, but like, back end stuff, was 72% of revenue, and that has declined down to 54%. So you're actually seeing the operating costs, economies of scale really come into place, which is very, very nice. And even if you were to back out the rather generous stock-based compensation out of its free cash flow that it claims, even at that, it's still generating cash at a good clip for a business that is in that higher growth mode that we have talked about, of being like, well, you're not profitable if you're growing this fast.
In other words, as this business scales, that 20% net margin could get even better.
Very possible, yeah.
I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 3 times. So go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 338% as of 12/21/2022 and are measured against the S&P 500 returns of 110% as of 12/21/2022.